Check on markets now. They have largely dismissed the biggest coordinated effort by the world's central bank since the global financial crisis back in 2008. Now, Asian markets closing in the red after the U.S. central bank slashed those key rates to near zero in a bid to counter the effects of the COVID-19 pandemic. China stocks dropping more than 3%, while in Hong Kong, the Hang Seng tumbled today 4% in trade. Meantime, Japan and South Korea, they also logged losses as well. The Kospi down some 3.19%, Nikkei down 2.46% in trade. Now, in the United States, stock losses have put a damper on trading. Wall Street hit critical circuit breakers, those levels twice last week, you might remember. And that's when trading was temporarily halted if there are wild swings in stock prices, and that's exactly what we saw last week. A case in point, the Dow saw the fastest 20% drop in Wall Street history. Now, investors are struggling to manage a rapidly changing scenario here. The Fed has promised emergency action that's worth $700 billion on top of cutting interest rates to near zero. We're back to quantitative easing. Central banks in Hong Kong and South Korea, meantime, they are the latest to cut their interest rates as well. Analysts also expect policy easing coming from Indonesia, Taiwan, and the Philippines as well this week. Now, the pandemic is sparking this mad rush for the US dollar as well. The greenback spiked to its highest level in 12 years last week, but the Fed and 5 of the major central banks, they have pledged to keep cheap dollars flowing worldwide. Now, they will offer the currency at a cheaper rate and over a longer maturity. Now, that's to make it easier to provide dollars for those hard-hit companies. There are going to be plenty of those, but analysts are saying that this won't immediately help emerging markets, also trying to get their hands on the greenback as well. Currency devaluation might pile on more offshore debt, in fact.